Neil from FERC. Dick's been instrumental in leading the modelling charge in FERC with connected programming models for dispatch models, and also is one of the strong advocates for OR in that group. So he's very pleased he's made the trip over from the US and he's going to give us a presentation.
Thank you, and thank you for inviting me. It's a real pleasure and privilege to come over here and find out what's happening. I was surprised at the interest in capacity markets, and you'll see that I have some views on capacity markets. And I should just give you my disclaimer. If you didn't know it already, I'm not speaking necessarily for the commission, the chairman, an individual commissioner. And the longer version of this is the US government. Simple question, why do you study power markets? Is because it's Willie Sutton's answer, it's where the money is. There's lots of money to be saved, and one of the things that we've been able to do is document that there's lots of money to be saved, and in some sense there's still lots of money to be saved in these markets. The topics I'm going to try to cover, but probably won't, are the history. One of the questions I always ask myself is, why are the Europeans doing one thing and we're doing another? And I think I've answered it for myself, but who knows? Efficient energy markets, capacity markets, and then I want to talk a little bit about transmission expansion and optimal topology, which are well, the optimal topology part is somewhat new. Transmission expansion planning has been going on forever, except it usually was the vertically integrated utility decided to build a generation plant, and then they called up their transmission people and said, make sure that gets to the market. Now we're not going to decide which generation plant to build, and we're going to do the transmission expansion anyhow, which essentially makes the problem a little bit harder. Okay, all right, so this is my part about why our markets are different. They evolved differently. Before 1935, there was no federal regulation, and electricity was essentially regulated by municipalities at first, and then later by the states. The predominant argument about why the states took over from the municipalities is because the municipalities were becoming corrupt. And essentially being bought off by the electric utilities. And probably the important thing is that they were using cost-based rates and benchmark rates. If you read some of the early history around Lake Erie, for example, the municipality would set the rates based on the rates of their next door neighbor or somewhere along the Lake Erie shoreline. And in those days, they were very small operations, and so you had a lot of benchmarking that you could do. But that pretty much disappeared over time. Now, over time, the utilities grew and started to cross state boundaries, but the states had no authority to regulate across state boundaries. And so in 1935, the Federal Power Act and later the Natural Gas Act gave the Commission the authority for rates in wholesale transactions, and required us to make sure they were just and reasonable, and using the double negative told us that there would be no undue discrimination. And my favorite example is that Ramsey-Boiteau pricing is due discrimination. When my background is in chemical engineering and very classical economics and optimization, and I'd never taken a course in regulatory economics. And so when I started to work in this area, I went to start doing some research to ask, what are just and reasonable prices? Now, you go to the dictionary, and it's not very helpful. You see that the history of just and reasonable prices was cost-based. But is it, if they wanted it to be cost-based, wouldn't they have said it should be cost-based? And so I did some more work, and I found the concept of a just price in Roman law, which was pretty much, anything that the contracting parties agreed to, which meant you couldn't force contracts. And then I found Diocletian, when he was apparently in trouble somewhere or another, set the maximum prices for a whole bunch of stuff, and it wasn't a financial penalty, it was a little bit more severe. But the fun debate was the debate in the 13th through 15th century in the Roman Church, and there were two sides of the debate: cost-based, whether the price of goods should be cost-based or market-based. And you found one set of scholars on one side and another set of scholars on the other side. But the interesting thing is that the debate was a just price could be market-based. And so, and there was a big clamor for the fact that especially in the gas markets, the gas price didn't have to be regulated, but we were required to do it by law. And the only tools we were using was cost-based regulation. And in fact, the idea was broader than that. Now, the way we regulated was what I would call average Johnson on steroids. There was reliability issues, cost of service. If the cost varied too much, we'd have cost pass-throughs. And that ended up with a huge gold plating problem. And it just didn't seem to work, although that was, to some people, the only tool we had. Also, for electric utilities at this time, there was little incentive and possibly a disincentive to do optimal dispatch, because if you optimized the system, you didn't have to make additional capital investments, and capital investments were where you made your money. And so software for optimal dispatch essentially had no real incentives to be developed or to develop even more than what was there. And if you look closely, a lot of the cost-benefit studies that we do all the time, it's considered really good if you can get to 1.5, but most of the software enhancements that have occurred over the last 20 years are greater than 100 and possibly greater than 1,000. And you can document some of them, not all of them, fairly strongly because you have natural experiments when you add software to the system, because the rules are that you have to run the system in parallel for 6 months. And so you run the system in parallel and you can actually calculate what the software is doing for you. And we have seen huge advances. During this time when the electric markets were growing and the state boundaries were difficult, you found that there were, at least in the Northeast, organizations that formed to operate across boundaries or to operate in a greater geographic location. And they basically argued that the reason they were doing this was to save money and to allow for better reliability. These three entities essentially were the first candidates for becoming ISOs because they were relatively easy to turn into ISOs. And they did trading on with what we called split the savings. That is to say that the entities would essentially send their marginal cost to the system operator, and they would look at marginal cost differences, and if they had the transmission capacity, they would split the difference between the two marginal costs, and that would be the price. In the 70s, we had the oil price shocks, and we went into a semi-frenzy as to how to deal with our energy markets. And in 1978, Carter essentially created a whole bunch of new energy laws. I was fortunate to be part of the team that did a lot of the analysis for this stuff, although we weren't sure exactly what we were doing. The Natural Gas Policy Act required partial deregulation of natural gas. It integrated the inter and intrastate markets. Today, it was mostly repealed. There's full deregulation of natural gas, which the NGPA essentially, I think, stimulated, but it doesn't have much to do with the way the markets operate today. So it was sort of an interim policy. The one piece of legislation that still is mostly intact is the Public Utilities Regulatory Policy Act, or PURPA, which forced vertically integrated utilities to purchase renewables and cogeneration power. This somewhat unknowingly created a new interest group in Washington called independent power producers, who were building these cogens and building the renewable stuff. Because some states set the cost for the renewables at a very high level. You could argue that the tariffs that were set back then were called feed-in tariffs, but we didn't have that name. They were required to purchase at what is called avoided cost, and avoided cost was delegated to the states. In California, New York, and Maine set very high avoided cost, and California got a lot of wind generators. In Texas and Louisiana, they got a huge amount of cogeneration. But the important thing that happened is that it established the idea that you could have independent power producers on the system and it wouldn't crash. There has been more than one set of testimonies that if you opened up the system or if you allowed independent producers, you would black out the system. Southern California Edison, being based in Los Angeles and Hollywood, actually put out a video where the storyline was independent power kills. And the way they presented it is that if the independent power producers don't care about being reliable, and so the lights will go out, and the final scene is a person on life support and fade to dark. The Fuel Use Act is even more interesting. We just literally outlawed natural gas in new generation plants. I think it only took a year or two to repeal it when we realized we pushed coal. We figured that, what we were worried about is energy independence, and so we had lots of coal, and so we said natural gas will be preserved for the higher valued usage, that is residential customers and feedstocks and things like that, and we'll just go with coal generators. Seems rather strange in the current context. But all of these laws, although they've come under criticism, they set the stage for deregulation and open access. Now, just a little bit of a review of the literature. I'm going the wrong way, aren't I? I recently, to my chagrin, discovered TURVI, but there was a huge debate that took place in Washington in the 80s. Ronald Reagan had been elected president, so we all had to study the Chicago School. Coase's articles on marginal cost pricing. I'm not sure people understand that, but I won't go into it. Dempsey says, oh yeah, auctions can replace regulation, but watch out for government failure and regulatory capture. The Cambridge School, the Western Cambridge School.
Real Cambridge.
Oh, really? Whatever. Josko and Schmalensky wrote a book on markets for power. It stimulated a lot of discussion, but it didn't end up that way. Schweppe, at the same time, at the same university, was writing a book on spot market pricing for electricity, which is the basis of most of the market structure in the U.S. And Hogan filled in a bunch of gaps with FTRs, CFDs, talked about reactive power pricing, and now is on a scarcity pricing kick, if you didn't know it. Where we start off with the value of loss load and multiply it by a whole bunch of numbers and essentially get a scarcity pricing curve. And then when I found Turvey, I then started looking for his papers, and to my great pleasure, he said he didn't like the definition of marginal cost. It was unrealistic in practice, and so he says marginal costs are incremental costs, which, as you'll see lately, makes me very happy. And then, in a short period of time, the Commission ordered access as a condition of a merger, ordered access, open access in natural gas and open access in electricity. But the power pools didn't like the rules for point-to-point contract transmission service, which in retrospect don't make a lot of sense, and they talked to us, and we essentially created ISO principles and said the alternative to the formal open access proposal was form an ISO under certain stated principles. And that essentially has been the moving force for competition in the US. And also we eventually changed our merger conditions to joining an ISO, but then we dropped that later on, and from then on the markets have evolved. Here's what the system looks like today. This area in here is essentially a California ISO is running a balancing market for most of the western states, and it's tied up in a lot of political issues, but it has a tendency to create an ISO in essentially this area here. And since the ISO is formed, PJM has grown, the Midwest ISO is formed, the Southwest Power Pool is formed, and the ERCOT market is formed. But we don't regulate ERCOT because it's wholly within the one state, and it's only interconnected to the rest of the system by DC interties. This is 10 years out of date, but it shows essentially that the ISO system at that point in time was about 2/3 of all the electric market and served about 2/3 of the population. And probably that's increased now to maybe close to three-fourths, but it is a phenomena, and it's growing. In the 2000s, when we were first starting to settle into these markets, all of a sudden wind and solar appeared, batteries and electric cars, and the need for capacity, the need for capacity turned into a need for flexible generators. And this is my opinion because we don't have a lot of this, the need for price responsive demand, and some people actually talked about involving the demand side, but I think the demand side has to be deeply involved in the system. You could almost make an argument that the first 100 years the prices were set by generators, and after that, 100 or so years, century I guess, the prices could very often be set in the future by demand. And by not putting demand fully into the market, you miss a lot of opportunities, and you have to create scarcity prices out of some calculations that only Bill Hogan and one or two other people can understand. Whereas if you put the demand side into the market, a lot of that issue goes away, because the demand gets off the system, it sets the price, and you'll see what we do today, which doesn't make a whole lot of sense. Old stochastics, generator failure was binary, demand was a function of temperature. You knew the peak was going to come in the afternoon on a hot day in August, and there were some off-peak issues you had to take care of, but that life was pretty easy. In dominant hydro systems, you had to plan for the end-year drought, but it was fairly clear that what you don't need in hydro systems or heavily renewable systems as it stands is a lot of capacity. You have more capacity than you could ever imagine. Oops. You have more capacity than you can ever imagine, so what you need is energy guarantees. So now we have a whole bunch of new weather stochastics. We're more aware of the fact that 70% of generator failures, weather has a large part to play in that, and and we've seen that in actual practice, because it's not just because it's cold, it's because when it's cold, things freeze up. And if things freeze up, generators can't start up. And we had an incident a couple years ago called the polar vortex, where we thought it was just simply a lack of natural gas, but half of the natural gas-fired generators couldn't start up. It's not that they didn't have gas, they just couldn't start up. They were frozen out of the market. And coal piles freeze. Wind, we recently discovered with another polar vortex, I mean, I'm sure the wind generators knew this, but nobody else did, that they shut down at around -20. They just don't operate. And they shut down in maximum wind. So the wind generators have an interesting profile. Just sort of almost at the time when you need them the most, they're gone. And we saw that recently in a polar vortex in the Midwest. Hydro is a function of rain and snow. And now, where's the peak? A cloudy, windless day. On a sunny, windy day, you're probably not going to have a peak. But on a cloudy, windless day, that's what you have to deal with. And it's hard to predict exactly when that's going to be. So we have new needs because of these new stochastics, and some of them are old, but we didn't pay any attention to them. But once again, to get the pricing right, you need the demand to be in the market. I'm going to skip over this because I was trying to figure out what the difference between Europe is, but I've come to the conclusion it's the fact that we require just and reasonable laws or prices, and just and reasonable prices have their basis in economic efficiency, and so we, at least I believe, we're charged with economically efficient markets. And I'm not sure that's a charge in the EU, and that market power comes under the competition directorate, and that's a different story. So I will skip over these and now move to ISO market designs. The ISO market designs are very closely tied to the physics of the system, and I think that's somewhat important. And I think I watched Sean's video. He was the first, Sean Meehan, and he said you don't need prices, and I agree with him. The optimal dispatch model doesn't need prices. It needs bids and offers. And if the bids and offers are at incremental cost or incremental benefits, you get the optimal dispatch, and you never have to know what the price is. You just have to send a dispatch signal. Except later on, later on, you have to send a price signal. And you need that to support the sustainable efficiency, that is entry and exit and remuneration of your fixed cost. So the optimal dispatch problem does not need prices, but prices have to soon follow so that you get the right signals and you avoid confiscation and a bunch of other things. Secondary goals here is that price risk essentially works through bilateral contract that the Commission doesn't pay much attention to. Good information comes out of the ISOs, and that market is very liquid when it's operating. We want to minimize government intervention and transactions cost, and we want to create easy entry and exit. That's easy to say and hard to do. Now, to me, every point in the system and every 5 minutes in time create a different product. And so it's a very difficult thing to characterize where and when market power occurs. And so the general philosophy in the the general philosophy is that we mitigate any market power by checking the incremental offers before the auction starts, and if we don't believe that there's something close to marginal or incremental costs, we fix it. Now, there are some holes in that, but that's the general philosophy. And so if you do that in a reasonable manner, you end up with an efficient market dispatch and eventually, and if you get the prices right, efficient markets. Oh, and one of the other important issues is that you can't get away with not having a balancing mechanism. So my argument would be is you have to do the balancing, do it right, and do it in an efficient manner. And so that's the whole idea of our real-time market. And you want these markets to be compatible with bilateral markets. There are a lot of bilateral markets that we probably officially don't regulate, but unofficially we leave them alone, because we believe that if you have access to a just and reasonable price in the real time or the day ahead market, that alone will discipline the other bilateral contracts that are created, because you always have the alternative of going to a just and reasonable price, and therefore a lot of these bilateral contracts are for mitigation or to make the bankers happy. Today we have essentially four markets in the ISOs: real time, which is every 5-minute dispatch; day ahead, which is essentially for efficient unit scheduling; generation capacity market, which probably I should drop the generation because they started off as generation markets, but now they have demand in, and they have demand in a potentially unduly discriminatory way. And we have transmission rights markets, which I won't say anything about today. But more importantly, and what we have tended not to pay a lot of attention to, is the transmission planning and generator interconnection problem, which is what we've been trying to address for the last 10 years, somewhat unsuccessfully, but we're making progress, I think. Market monitoring, I sort of said this, but just to repeat it, it's essentially the network has these thermal and voltage constraints, which creates pockets of market power that change on an hourly basis and and moves from location to location. And so the idea that you could do some classical market power analysis on these markets is a little bit strange, in my opinion. And that's why we mitigate the bids going into the markets as opposed to trying to do some kind of classical analysis. Our initial shot at ISO markets had a bunch of failures. Einstein said stupidity is doing the same thing, expecting different results. Each one of our ISOs essentially started with zonal markets, and sometimes less than a year realized that they failed, and essentially went to nodal markets very quickly. But it was amazing that each one of them knew what was happening and made the same mistake. And one of the reasons is because nobody optimized the system prior to that, and so they would leave huge margins on the transmission system, and it would look like there was no congestion whatsoever. So why have nodal markets if there was no congestion? And as soon as they optimized, the congestion just showed up overnight. We had some bad day-ahead markets. The California Power Commission was shut down a decade or so ago, 2 decades, but it still exists.
Legally?
It's sitting on the top of a bunch of money, but where the refunds haven't been fully decided yet. Separate reserves markets, reserves markets as that tome that Ben and a few others put out say you have to co-optimize, which when you co-optimize it creates the arbitrage condition. CalISO decided that they didn't need to do that, they needed to do some other ways, and they had what is called price inversion. The lower quality reserves got higher prices, which didn't make a whole lot of sense. Reactive power, the argument was it was imaginary, and if it wasn't imaginary, it was free. And as I hope to show you that it's anything but free. We also have free primary frequency response, which is probably the most important frequency response in the system, and that's because the engineers insisted on it. This was a strange debate. And in California, they prohibited long-term contracts for reasons that don't make any sense today. And so we had missing money, we had missing market signals, we had LMP settlements, but to keep from confiscating the bids, we had to add uplift to the payment. And then in 2005, the Energy Policy Act passed, and it very explicitly said that we were supposed to promote reliable and economically efficient transmission and generation. They left out the term demand response, but I'll just put it in there. I always mentally put it in there when I read that. And I would argue that reliable markets are part of economically efficient markets, because if you have a blackout, it's very expensive, and that would make it very inefficient. So I stress, as I did here in red, economically efficient, and then in section 210M, Congress essentially ratified ISOs saying that the avoided cost rate was the energy price in the ISOs. And there was some other stuff. Our day-ahead markets are hourly. They run for 24 hours at a time. The ISOs often add on a few extra periods to avoid end effects. And we try to match them with the physics of the system. And we do that by having a linear or a mixed integer programming model for the dispatch. Then we check to see if this dispatch is AC feasible. If not, we add some linear constraints to try to bring it back to feasibility and iterate through this process. And if we run out of time, tough luck. You just take what you got. Real-time markets, we now are at the 5-minute level. They sometimes could have look-aheads up to 4 hours, but only the first period is financially settled. This creates some problems, but we'll go into it right now. And essentially, we go through the same process, but since we have a solution that's fairly close to the next 5-minute solution, the market software solves a lot faster. Reactive power. Now, in the US, the standard way of dealing with reactive power is because in certain high consumption times, voltage falls in the big cities. And for reliability reasons, you like your reactive power to come from generators. And to get reactive power from fossil generators, what you have to do is start up the generator, run it at its minimum real power output, and then get the reactive power. The marginal cost of the reactive power is zero. The incremental cost of the reactive power is the startup cost, the fact that you have to continuously run it at its minimum operating level, and maybe even have minimum runtime. So there's a whole bunch of costs laying in there, but the marginal costs are zero. And that argument, to me, just doesn't play very well. And not only that, when you start up these units and set them at their minimum operating level, guess what happens to the LMP? Drops. So to me, this methodology doesn't make a lot of sense, and it needs to be revisited. The biggest, and this starts my capacity story, and this is true in a lot of markets, a lot of electricity markets. On the peak hour, it's costing you $1,000, these are just rough terms, to produce the energy, and the price is often less than $100. That shouldn't make any sense to anybody. And one of the reasons why that's happened is because for a long period of time, most consumers never saw the hourly price or the 5-minute price or any other price, so they basically couldn't react to it, and they got a monthly bill It was the average of everything. So when my wife turns on the dishwasher and does a 3-hour setback, I tell her, you're helping the world, but you're not helping us because we pay the same amount of money. The same is true for charging our electric vehicle. Doesn't matter if I come home and plug it in at 6 o'clock rather than starting charging it at 11 or 12 or 1 or whatever, because I pay the same. But just because I feel obligated, I lay off. Well, actually, when my daughter does it, she just plugs it in and comes upstairs. It's a nuisance to charge your electric car correctly if you're not seeing the price, because you have to then go downstairs and plug it in after you've actually come upstairs and all kinds of things like that. Now, the problem with one of the reasons why we haven't pushed price responsive demand is it creates a very large two-sided market, and that creates computational problems. So there's been a sort of reluctance to do it for computational reasons, and generally you have to go through the states in order to get the demand side to participate, and that's not always an easy thing to do. My argument is that when you have this demand side participating, that is bidding into the market, you get to use the thermal envelope of the building stock as storage. It's already there, you don't have to build it. All you have to do is put some equipment on it, and you can manage the building as a storage facility. And I would say it's 10 to 100 times cheaper than putting in a Tesla battery, which is designed for mobile operation rather than stationary operation. Okay. Oops, I turned it off. Okay. So we want, this is one of Hung Po Chow's slides from before. It's his properties for an efficient market. I won't repeat them here, but you'll see them turn up later on. Now, convex pricing theory. Again, my newfound idol, Turvey, said that it's oversimplified. And it's great for teaching your introductory econ course, but not for electricity markets. In convex markets, the LMP is theoretical pricing goal for market efficiency. It's the enter and exit criteria. It clears the convex market. It's just a wonderful thing, but it does need two sides. Whoops. Oh, just took a little bit of time to build it. Okay, so here's a typical situation. You have your friendly vertical demand curve and a bid stack, and the system clears the market at $30. The $30 generator doesn't make any money, it simply breaks even. And the demand is what it is, I guess. Oh, I didn't realize this thing was... Okay, didn't mean to build this thing up like that. But then you run into the situation where you run out of generation, demand's over here, and so what do? Well, we then initiate curtailment. And curtailment moves the demand by, you're just chasing people off the system. It moves the demand into the feasible area for generation and sets the price at $30. What should have happened if you had price responsive demand in the market is that, sorry about this, I didn't mean to do this, is that you go from this situation, if you have price responsive demand in the market, to this situation. I call this the organic solution as opposed to the inorganic solution of scarcity pricing. If you have a demand curve, actually the market will clear by getting some of the demand off the market. And not only that, but the marginal unit here makes scarcity rents, which essentially, if you do this right, is going to be enough money to stimulate the capital investment and keep the market operating over a longer period of time. And so in our zeal for a whole bunch of different reasons, we don't have the demand side in the market, and we have prices that arguably are way too low to stimulate new generation and to stimulate a lot of the demand response that we're not getting. I mean, today what we do is we create an efficiency program which doesn't deliver as much as it's promised. Now, that's convex economics. Now we have non-convex economics. ISO markets have flow equations that are nonlinear, have binary decisions on startup and minimum runtime, and many approximations. And what we do is we essentially simplify the market, but it looks to be like it simplifies and works fairly well. But the important thing is that we need prices. Ideally, what we would need is prices to stimulate a sustainable market and investment in an organic way, but we don't have them today. In non-convex markets, which has been what I've been working on for the past 10 years or more, the analogies break down. LMP is not efficient. It does not clear it may not clear a non-convex market. By itself, it's usually confiscatory. In other words, it doesn't even return the incremental cost of generators who are part of the optimal dispatch. So it creates, in a sense, winners out of auction, losers out of auction winners if you try to use just the LMP. It sends weak entry and investment price signals, and it usually needs a make-whole payment, which sits outside of a lot of the stimulant issues. And if, in fact, your unit has a minimum operating level, which all fossil units do, and nuclear units, the marginal cost of that unit is usually greater than the LMP. And no ISO today uses LMP pricing. The Cal ISO and SPP uses LMP plus a make-whole payment. The New York ISO and PJM relax the minimum operating level, but additionally make-whole payments if necessary. And MISO and the ISO New England have binary relaxation with make-whole payments. And they actually put some of the incremental cost into the marginal cost function when they run the pricing algorithm. Pricing algorithms essentially are separated from the optimal dispatch algorithm to get the prices right. And that doesn't have to be for convex markets, but in non-convex markets, I believe it's absolutely essential. And like I said, none of our ISOs do pure LMP pricing. And the make-whole payment is problematic because it's not transparent. And it has weak ex-post allocation of cost, and it causes some incremental. Try not to use inframarginal, but incremental generators from making a profit. Okay, 5 minutes. Where are we? Oh, this is a combined cycle generator. This, up here is its marginal cost curve. And it's actually a simple combined cycle. And if you had plotted this as the residual demand curve, you would find that this generator has 1, 2, 3, 4, 5 local optima. Luckily, the mixed integer program finds this one, the one with the largest market surplus, and has an LMP down around here. But without the mixed integer programming software, you would just be landing on one of those sort of randomly. So what about non-convex pricing? The objective is to allocate the cost to the entities that cause them. Convex markets, LMP does all that for you. But now what we have done is created a pricing run, and the prices no longer are marginal cost prices. They're basically just different, and they're different pretty much for every ISO. And we have to implement, if we do this, we should, or actually do, implement a form of Ramsey-Barteau pricing. I don't have enough time to get into that. I'll skip over this. This is a simplified version. This is, by the way, what a fossil fuel generator looks like in the classical dispatch the supply and demand. It starts off with an average cost up around here, and its costs come down asymptotically to between its P max, its minimum, and its maximum. And if you modify the marginal cost function in such a way, what happens is the market clears where the average incremental costs intersect the demand curve, not at marginal costs. So this basically allows you not to have a make-whole payment, and it gives all the incremental generators a profit. And you can illustrate that if you have a whole bunch of these fossil units, you have a whole bunch of these average cost curves, the market clears up here, and all of these entities make money. Let's see, I have to hurry up. Oh, when you start working on this stuff, you find some very interesting things. In multiple period markets, when the generator has a minimum runtime, this algorithm will allocate the cost to the period that needed that generator, not over all of the units. In networks, and this is a fascinating phenomenon that quite frankly, I don't think any of the ISOs knew about it until recently. You can run this algorithm and you get flow gates with zero marginal cost, which would tell you that there's no reason to increase the capacity on that flow gate. But the answer is no, because at zero, or at a small increment of capacity increase, there is no value. But if you get to the incremental level of the capacity on the flow gate, you can displace a unit that's operating at its minimum operating level, and it then has value. So the flow gate marginal cost can send the wrong price signal to expansion of the network. In summary, the locational incremental price has a whole bunch of positive attributes that, to my knowledge, none of the other pricing mechanisms have. It has no make-whole payments. It's compatible with price-responsive demand, but there's still a few problems to work out because it may not be sub-market perfect, and if you're interested in that discussion, I'll talk about it offline. Oh, and in these non-convex markets, entry is lumpy. Certainly, if you can enter at the LMP 0, oh, okay.
1 minute.
Oh, okay. I didn't. All right. So there's multiple entry points in these markets. For example, at LMP, you can enter the market, but if you can enter the market at the locational incremental price, if you can enter it at a certain level, and that's an efficient operation, but it's a signal. This is a higher price than the LMP, so it's a different signal for different generators, and arguably you can have a multitude of these things because you discretely replace certain generators in the market. And so that, again, the LMP is a very incomplete story for price signals for entry, exit, and things like that. This is arguments about once you have the demand side into the market, you don't dispatch a generator until the residual consumer surplus is greater than the incremental cost of the generator you're dispatching. And so sometimes that doesn't happen, and again, the demand side will set the price. This is just a bunch. Oh, and actually, capacity markets have become almost unmanageable, and since I don't have any time, we'll just go through this. I was going to talk about transmission expansion, no time for that. I was going to talk about optimal topology. By the way, optimal topology is something that should be done everywhere from planning until up through corrective switching, and it's been a lost art until the last decade or so. Thanks to Michael Ferris, who allowed us to solve the problem without infinite time. Distribution operation. I was going to talk about nonlinear optimization, which is I think it's a very important part of any kind of efficient market design. Done.
I'll ask Natalia to.
Yeah, so Ben, how it's gonna do that.
Okay, two quick comments. We learned that the people in this room are not the first ones to study one field and then move into another, electric power engineering or chemical engineering into economics. St. Augustine did that also. I don't know if he was an electric power engineer first, but then became an economist. So among
Good
many
question.
other things we learned from Dick's talk and chew on. By the way, these slides will be posted and available. Folks, you definitely should spend time with them. I would invite a conversation. So the notion of using average incremental cost to clear markets, I'm relating it to what Bert and Parr talked about yesterday. I think it was Bert. You compared the European system of folding all fixed costs into your bid versus the American system of bid cost recovery for fixed costs, and look at the impacts of equilibria. Looking at Dick's system, I think that would be very useful. It would help make it precise. How would it actually work? What would the settlements be? And then what might its impacts be on investment? It was your talk, right? Yeah, it did that. So that I guess is a coffee conversation. But since this meeting is on investment, I thought I would ask the following, Dick. So there's been a lot of discussion about the need for and design of capacity markets. So I want to ask, do you think anywhere do we see the mix and location of generation being really driven by economic fundamentals? Or is it completely so political or haphazard that there's no hope in trying to predict it, or to try to design mechanisms to make it, economic mechanisms that make it more efficient? Are we just proving theorems? I'll show one later, but not really doing anything that's relevant to the real world? Or is there a role for economic fundamentals in trying to improve those in generation investment?
My answer is I take a middle ground position. I'm not necessarily opposed to capacity markets, but I believe they have way too much money in them. And that, where's my, most people don't like this, but where is it? Here it is. If your energy market is running efficiently, the capacity market expected clearing price should be zero.
Most of the money should go through the spot market.
Rewarding
capacity for when it's available.
You can have your capacity market anytime you want. By the way, capacity markets may have made sense 10 years ago, 15 years ago, but they buy capacity. And the capacity of a nuclear plant and a coal plant is the same as the capacity of a combined cycle plant, and they have vastly different flexibility. Operating range, ramp rates, you name it. And you're not buying that. So what are we buying in a capacity market, or at least in the capacity markets in the U.S.? And the way we do it in the U.S., we have way out of date parameters that we use to create the supply curve and the demand curve, and by the time and I dare people to tell me what 1 in 10 means, but we design it off of that. So it's I just don't. I'm not against. Well, maybe I am. What I'm against is too much money in the capacity markets. And the reason we formed capacity markets was not reliability, yada, yada, yada. What we did is we said, oh, there's missing money in the energy markets, so let's create a capacity market because we fear that high prices wouldn't be politically acceptable. I don't believe that, by the way, because we allow people to hedge. If you don't like, as a matter of fact, whoops. My bad. What was I going to say before I disrupted myself?
High prices.
Yeah, the thing is that a lot of these prices are just moving from the capacity market into the energy market. It's not clear exactly how that's going to be bad, but we have over-relied on our capacity markets while suppressing our real-time market prices. So if you're, there's politics in all of this, and that makes the exception. But you need to get the demand side into the market and active. That's going to create higher prices in and of itself. It's much easier to justify than a scarcity pricing curve that's predicated on the value of lost load, which we're not really sure of. So have the capacity markets, but don't overuse them. It just, like I said, I'm nervous about overuse of capacity markets. Because, the energy market should be enough to stimulate and sustain the market. Now, there's a lot of, in the United States, we don't have a carbon price, so there's a whole bunch of issues associated with carbon prices, and so we have subsidies and all kinds of other things. You have to deal with that, but, as your first option should not be the capacity market.
Thank you.
Sorry about breaking this.
Thank you so much. One for
Sure, that's up to you.
Okay, I think probably we'll have time for one question before we move to the next talk. Richard?
If I'm allowed a comment, average incremental cost sounds very much like the rule that was used in the electricity pool of England and Wales to set the price in all except the very low demand periods.
Because they haven't added.
No, they just took for each power station no load cost divided by output plus the incremental rate plus start costs over the amount of time it was going to run for, called that its stack price, and the highest stack price of a generator in normal operation was the price for everybody.
Yeah, that sounds almost exactly like this, except that to do the dispatch, this is for pricing. To do the dispatch, you basically have to do economic dispatch and not stacking things.
They also did the economic dispatch and then they did that calculation.
And that was Ralph's work?
Whether Ralph talked to the people involved, I'm not sure.
He was the government expert for a while, wasn't he?
Electricity Council and World Bank, I think.
But this comes out of the original scheduling algorithm for the vertically integrated system.
Oh, yes.
And so they just translated it into...
Yeah, the vertically integrated utility was the optimal system planner, except it operated the process.
Great. Thank you so much. Then we're gonna